Welcome to the Deep Dive. I'm Mark.
And I'm Sarah.
Today we're taking a focused look at, well, a really crucial set of reports from industry legend Bob Marshall. We're talking about his August 2025 labor market observations. And these are particularly significant, aren't they? They're coming right after last month's numbers, which, well, frankly, left many of us feeling a bit perplexed.
Yes, there was definitely some confusion, maybe even controversy surrounding those July figures. So getting Bob's take on August is timely.
Absolutely. Bob spent years meticulously watching this data, and his insights, especially for recruiters like you listening, are just indispensable.
He has a knack for cutting through the noise, doesn't he? Looking beyond the headlines.
Exactly. So our mission today is clear. We want to distill the most impactful findings from these August reports and really explore their direct relevance to your work, help you adapt.
It's vital. Given the context of last month, this August data truly requires that detailed examination. Bob consistently forces us to look at the why behind the numbers.
Okay, so let's dive in. Let's start with those top-line numbers from August. At first glance, they might seem a bit concerning.
Right.
We saw the U6 unemployment rate, the broader measure, rise to 8.1% in August 2025. And the regular unemployment rate, the U3, it climbed to 4.3%.
And those numbers, just taken on their own, could seem, well, scary.
They could. Someone just glancing might think things are heading south quickly. But as you said, Bob Marshall's analysis always pushes us deeper.
Precisely. He encourages that look beyond the initial figures, questioning the influencing factors, resisting that knee-jerk reaction.
So where do we start peeling back the layers? What's underneath those headline rates?
Well, interestingly, despite those unemployment figures, one of the sources Bob uses, the Principal Financial Well-Being Index from August business articles, shows a kind of resilience.
Resilience. In what way?
It gives us a window into U.S. business confidence. Now, confidence is still near historic lows, let's be clear.
Okay.
But it did climb modestly. It went to 6.89 out of 10 in August. That's up from 6.02 back in April.
So a slight improvement, but still low overall.
Exactly. It's still well below the 8.08 it was a year ago. So there's definitely lingering caution among business owners.
And what's driving that caution, according to the index?
The main culprits cited are ongoing policy changes and, significantly, new tariffs. These external economic pressures are creating real challenges.
Tangible challenges. Can you elaborate on how these tariffs and policies are actually impacting businesses day to day?
Yes, the report is quite specific. Principal's research found that 58% of U.S. businesses say tariffs are negatively affecting their operations. That's over half.
Wow, okay.
And it's even more pronounced in certain sectors. Retail, 70% report negative impacts. Manufacturing is right behind at 69%.
So they're feeling the pinch. How are they responding? Are they cutting costs, laying people off?
Well, they are taking action, but maybe not in the way you'd first expect given the pressure. We see 33% have already raised prices.
Passing the cost on.
Right. And another 35% plan to raise prices in the next 12 months. So inflation is definitely part of the response.
Okay, price hikes. But what about staffing? That's what our listeners are really keen on.
And this is where one of Bob Marshall's great insights comes in, highlighting this crucial countertrend. Despite the cost pressures, most businesses are actively maintaining their workforce.
Really? Even with tariffs hitting hard?
Yes. Nearly half, 48%, said they'd only consider staff reductions as an absolute last resort. And even more strikingly, 70% said they'd never, or only under extreme circumstances, eliminate employee benefits.
That's remarkable. Protecting their people.
It gets better. The same research showed 50% of businesses actually increased their staffing levels in the past 3 months. Only 13% reduced staff.
That paints a very different picture than just looking at low confidence scores.
It absolutely does. It speaks volumes about their strategic priorities. They see talent as key.
There's a quote from Amy Friedrich at Principal, isn't there? She's the president of Benefits and Protection.
Yes, it sums it up perfectly.
She said, business owners are adapting to tougher conditions and treating layoffs as a last resort. Their priority is keeping teams intact so they're ready to capture growth opportunities when uncertainty lifts.
That really illuminates the why, doesn't it? It's a long-term strategic view. They're protecting their ability to grow later.
So for you, the recruiter listening, this signals, well, a continued, stable demand for skilled talent.
Yeah.
Even when the economy feels cautious.
Precisely. Businesses know talent is their engine for future expansion. It means the need for quality talent persists. It might just become more focused, more targeted.
Okay, that's a crucial piece of context. Businesses are cautious, but prioritizing talent. Now let's shift gears slightly. Let's look at the ADP National Employment Report for August 2025. This gives us hard numbers on private sector job creation.
Right, the ADP
The
numbers.
report showed an overall increase of 54,000 private sector jobs in August.
Which, honestly, isn't a huge number overall.
It isn't massive, no. But what really jumps out is where most of that growth came from. Small and medium-sized businesses.
Ah, the SMBs.
Exactly. They accounted for over 67% of that new job creation. That's 37,000 jobs from small and mid-sized companies.
That's significant.
And this is where another of Bob Marshall's great insights comes into play. He says, and I'm quoting him here, "Our bread and butter, especially for those of us working on the contingency side of the house, has historically been and continues to be small and medium-sized client companies."
He emphasizes they need to be part of your niche right along with the big players.
Precisely. He adds, along with the large companies, these companies need to be included in your niche. It's a direct call to action for every recruiter listening.
So think about your client mix. Are you giving SMBs the attention this data suggests they warrant?
How does this insight reinforce your strategy? Or maybe challenge it? It really underlines the vitality of that market segment.
And the ADP report breaks it down further by industry, which adds more color. While the total was 54,000, it wasn't uniform growth.
Where did we see the gains?
Leisure and hospitality had a really strong month, adding 50,000 jobs. That's almost the entire net gain right there.
Suggests people are still spending on experiences.
Seems likely. Construction also did well, adding 16,000 jobs. Maybe infrastructure projects or specific regional housing demand?
Okay, so gains there. But obviously, to get a net of 54,000, some sectors must have lost jobs.
That's right. Manufacturing saw a decrease of 7,000 jobs. That sector is often sensitive to economic shifts. Trade, transportation, and utilities lost 17,000 positions. That's quite a drop. Could be supply chain adjustments, maybe cautious consumer spending on goods.
Any others?
Education and health services were down 12,000, which is a bit surprising given its usual trajectory. And even financial activity saw a small dip of 2,000 jobs.
That's quite a mixed bag.
Yeah.
Leisure hospitality way up, but losses in manufacturing, trade, even health. What's the explanation from ADP's chief economist, Dr. Neela Richardson?
Dr. Richardson points to a few converging factors. First, persistent labor shortages in certain skills. There's still a challenge even if the market is cooling overall.
So employers can't find the people they need in some areas.
Correct. Second, she mentions more cautious consumers. If people pull back on spending, demand slackens, and hiring slows.
Makes sense.
And third, significantly, she highlights the increasing impact of AI disruptions.
Automation and technology shifts.
Yes, it could mean fewer roles needed, or companies rethinking their workforce structure because of new tech capabilities. It creates a complex environment.
Okay, so job numbers are complex. What about pay? The ADP report also tracks pay trends, right?
It does, and this is really crucial for recruiters. It showed year-over-year pay growth for job stairs. People who stayed in their jobs was 4.4%.
Okay, 4.4% for stairs. What about job changers?
Significantly higher. Job changers saw pay growth of 7.1%.
Wow, 7.1 versus 4.4. That's a big gap.
It's a substantial difference, and it has major implications for talent acquisition strategy.
Can you break down the pay for job stairs a bit more? By industry or company size?
Sure. For job stairs, financial activity saw a 5.1% increase. Manufacturing, 4.7%. Other service sectors were mostly around 4.2 to 4.5%.
And by company size?
Larger firms, 500-plus employees, saw 4.8% pay growth for stairs. But small firms, 119 employees, saw only a 2.5% increase.
So smaller firms are lagging a bit on pay increases for existing staff.
It appears so, but the big story is that gap between stayers and changers, 4.4 versus 7.1%.
What does that mean for you, the recruiter, trying to lure someone away from their current job?
It means your offer has to be compelling, significantly compelling, often financially. To entice someone happy and employed, especially a top performer, you need to present a demonstrably superior opportunity.
A marginal increase isn't going to cut it.
Not according to this data. Job changers are clearly motivated by and achieving more substantial gains. This empowers you to advise your clients. You need competitive compensation, likely well above the stayer rate, to attract passive talent.
You're not just offering a job, you're offering a major upgrade.
Precisely, a value proposition that overcomes their current comfort and compensation.
Okay, that's very clear on the compensation front. Expectations are high for job changers. Let's move to the next key report. The U.S. Bureau of Labor Statistics, JOLTS, report job openings and labor turnover survey. This is for July 2025 data.
Right. JOLTS gives us insights into openings, hires, and separations.
It showed the total number of job openings was largely unchanged in July, sitting at 7.2 million.
7.2 million openings. Sounds like a lot.
It does. But again, Bob Marshall provides a perspective that completely reframes this number for recruiters. This is one of his most powerful insights.
The hidden job market point.
Exactly. He says, and this is critical, as we recruiters know, that 7,200,000 number only represents 20% of the jobs currently available in the marketplace.
Only 20%.
Only 20% are published openings. He continues, the other 80% of job openings are unpublished and are filled through networking or word of mouth or by using a recruiter.
So the real number of opportunities is much, much larger.
Do the math based on his figures. So those 7,200,000 published job openings now become a total of 36,000 published and hidden job orders.
36 million. That's a staggering difference.
It fundamentally emphasizes the importance of that hidden market. That's where recruiters earn their keep, isn't it? Beyond the job boards.
It absolutely is. That's our primary playing field. Now, drilling into the JOLTS details for those published 7.2 million openings, we saw some shifts by industry.
Where did openings decrease?
Healthcare and social assistance saw a big drop, down 181,000 openings. That's notable for a sector usually seeing growth.
Any ideas why? Reevaluating needs, funding shifts?
Could be either or both. Arts, entertainment, and recreation also saw a decline, down 62,000, maybe reflecting cautious consumer spending again.
Okay.
And mining and logging was down 13,000, often tied to commodity prices.
So softening demand in some specific areas for published roles? What about hires, people actually starting jobs?
Hires were unchanged overall at 5.3 million in July. Steady, but not accelerating.
Any movement within that?
There was an increase in the other services category, up 86,000 hires. That's a broad category. Personal care, repair, maintenance, so diverse pockets of growth there.
Okay, hires stable. What about the other side separations, people leaving jobs?
Total separations were also unchanged at 5.3 million, so hires and separations basically balanced out in July.
Let's break down separations. What about quits? People leaving voluntarily.
Quits were unchanged overall at 3.2 million. The quits rate is a really key indicator, right? It measures worker confidence, their willingness or ability to leave a job.
Higher quits usually means workers feel confident they can find something better.
Exactly. And interestingly, within that stable overall number, quits increased significantly in professional and business services, up 197,000.
Suggesting high confidence among those workers.
It certainly points that way. They feel secure enough to make a move. But conversely, quits decreased in construction, down 80,000, and in transportation, warehousing, and utilities, down 49,000.
Less confidence there, perhaps, or fewer appealing alternatives?
Could be a mix of both in those sectors.
Okay, that's quits. What about layoffs and discharges and voluntary separations?
Also unchanged overall at 1.8 million in July.
Any notable shifts within that?
Yes, layoffs decreased in professional and business services by 130,000. That's a positive sign for that sector, fewer involuntary cuts.
Good news there.
But there was a small increase in layoffs within the federal government, up 5,000. Might be specific departmental changes or budget issues.
And JOLTS often includes revisions to previous month's data, doesn't it?
It does. For June 2025, job openings were revised down, while hires and total separations were revised up slightly. This is standard procedure as more data comes in and seasonal adjustments are refined. It ensures accuracy over time.
Okay, that's a very detailed picture of the churn, openings, hires, quits, layoffs. Let's zoom out again to some broader indicators. What about advertised job demand online?
The Conference Board Lightcast Help Wanted Online Index, or HOL, tracks that. It actually declined slightly by 0.1% in July 2025.
Not a huge drop, but follows a bigger decline in June.
Right. It followed a 3.6% decline in June. And looking year over year, it's down 1.0% from July 2024.
So a consistent, albeit gentle, downward trend in advertised online vacancies suggests some softening in broad demand.
It does suggest that. Now, let's loop back to that broader U6 unemployment rate we mentioned at the start, the one that rose to 8.1% in August.
Yes. How does that 8.1% compare historically, just looking back a year or two?
Well, the 8.1% in August 2025 is higher than recent years. It was 7.9% in August 2024 and 7.1% back in August 2023.
So a clear upward trend in that broader measure recently.
Yes, it indicates a subtle shift, and it's crucial to remember what the U6 includes.
Right, it's not just the officially unemployed.
Exactly. It includes marginally attached workers, people who want a job, looked recently but aren't actively searching now, maybe discouraged.
Okay.
And it includes those working part-time for economic reasons, people who want full-time work but can only find part-time.
So it captures underemployment and some level of disengagement.
Precisely. It gives a much fuller, often more challenging picture of labor market slack than the standard U3 rate. Understanding our rising U6 helps us sense the broader economic pressures clients and candidates face.
A more comprehensive view of struggle. What about the population completely outside the labor force? Not working, not looking.
That's the not in labor force, or NIL population. It stood at 103,223,000 in August. Huge number.
Over 103 million people. Did that number change much?
It actually decreased by 220,000 from July, a slight move back towards the labor force, perhaps.
Bob Marshall had a question about this group, didn't he?
He did, a really thought-provoking one. He asks, if that is the case, how do they survive when they don't earn any money because they don't have a job? Are they all relying on the government to support them?
It really makes you consider the diverse situation: savings, family help, informal work.
Exactly. It prompts critical thought about economic realities beyond formal employment.
What about the participation rate? The share of the population that is working or looking?
The employment participation rate rose slightly to 62.3% in August, a tiny uptick.
But still low historically.
Very low. It's only 0.1% lower than September 2015, and before that you have to go back to October 1977 to see a similar rate.
Wow, 1977 levels. That's a long-term trend of reduced participation.
It really underscores that. And Bob Marshall connects this low participation to the unemployment rate itself with another key insight.
What's the connection?
He says fewer people looking for work will always bring down the unemployment rate.
Because if you're not looking, you're not counted as unemployed.
Exactly. So a lower unemployment rate doesn't automatically mean a booming job market if participation is also low. It can mask underemployment or disengagement.
That's a crucial nuance. What about the BLS numbers for total non-farm jobs added in August?
The BLS reported very little change there, a small increase of just 22,000 non-farm payroll jobs in August. Pretty flat since April, really.
Who were the shifts?
A gain in healthcare was mostly canceled out by losses in federal government jobs and in mining and related sectors.
And were there revisions to prior months here too?
Yes, June's gain was revised down, July's was revised up, but the net effect over those 2 months was a decrease of 21,000 jobs compared to what was previously reported. Data refinement is ongoing.
Okay, so the overall job growth number was minimal, and participation remains low, even if the headline unemployment rate isn't extremely high. This brings us to the absolute core for our listeners: reframing unemployment from your perspective as a recruiter.
This is where Bob Marshall's analysis is so vital.
We acknowledge the general rates, but they often don't reflect the reality of recruiting for specific roles. Marshall directs our focus to the segments that matter most to us.
Right, the professional and degree holder markets.
Exactly. For management, professional, and related types of workers, the unemployment rate in August 2025 was just 2.7%.
2.7%, very low.
And that was actually down 0.3% from July. So that specific market got even tighter. And for college-degreed workers, 25 years and older, the rate in August was also 2.7%, unchanged from July.
Also 2.7%, consistently low.
These rates are dramatically lower than the 4.3% general rate or the 8.1% U6 rate.
Night and day difference.
So the direct challenge to you listening: what does this incredibly low targeted unemployment rate mean for your daily search? How should this fundamentally shift your approach?
It forces a complete paradigm shift, really. It connects macro theory to micro reality. Think about Milton Friedman's concept of the natural rate of unemployment, or NARU.
The unavoidable minimum unemployment, usually pegged around 4–6%.
Exactly. Economists often use 5%, maybe even higher now, like 6.7% as a new normal. That's for the whole economy.
Okay.
Now, apply that idea to our specific target groups. Bob Marshall's insight here is blunt and powerful. He says, if this rate NARU is applied to our main category of management, professional, and related types, and or our other main category of college-degreed potential recruits, we are well below the 4–6% threshold for full employment.
Meaning?
He concludes, we find no unemployment, none, zilch. A big goose egg.
No unemployment in the pool recruiters are actually fishing in.
Effectively, yes. For practical recruiting purposes in these high-skill areas, the candidates you truly want are almost certainly already employed and likely valued. Your job isn't filling vacancies with the unemployed, it's strategic talent scouting among the employed.
Changing the value proposition entirely, not, I have a job, but I have a career-defining opportunity.
Precisely. It requires proactive engagement, understanding aspirations, building relationships long before someone thinks of moving.
And does the historical data back this up, this idea of perpetually low unemployment for these groups?
Absolutely. Look back 25 years. August 2000, a strong economy. Rates were 1.8% for management professional and 1.7% for college degreed. Rock bottom.
Wow.
Even during the pandemic peak, August 2020, they only hit 5.5% and 5.3% respectively, still within or just above that natural rate band for the general economy.
So it's a consistent long-term reality. The market for top talent is always tight.
Always. Understanding the types of unemployment helps clarify why this is. Economists identify 5 main sources.
Okay, let's quickly touch on those first.
Cyclical unemployment. This rises and falls with the economy. Recessions cause layoffs, recoveries bring rehiring. For recruiters, it means adapting to client freezes or sudden talent floods from struggling sectors.
Tied to the business cycle, what's next?
Frictional unemployment. This is the normal, healthy turnover people between jobs, entering the workforce, retiring. It's usually short-term.
So this is actually where recruiters often find candidates who are open to moving.
Exactly. It's fertile ground. Your role is efficient matching to minimize their time between jobs. Third is structural unemployment.
This is about skills mismatches.
Yes. Technology changes, industry shifts, jobs moving, leaving people with obsolete skills. Think automation replacing manual labor. This often requires retraining and lasts longer.
So recruiters need foresight here, identifying emerging skill.
Definitely. Advising clients on talent development, helping candidates reskill. Fourth is seasonal unemployment.
Like construction in winter or retail during holidays.
Precisely. Tied to predictable times of year. Recruiters handle this with temporary roles or helping seasonal workers find complementary off-season work.
And the last one.
Surplus unemployment. This happens when wages are pushed above market clearing levels, maybe by minimum wage laws or strong unions. Companies might hire less if labor costs are artificially high.
So recruiters need to understand wage dynamics and advise clients realistically.
Right. And beyond these 5, other factors matter too, like the length of unemployment benefits, up to 26 weeks usually. Some argue longer benefits might slightly reduce incentive for taking less desirable jobs quickly.
And the economy itself. GDP.
Yes, changes in GDP are key, but unemployment lags behind GDP improvements. Hiring takes time, so a stronger economy doesn't instantly mean lower unemployment figures.
Understanding all these facets gives a much richer picture than just one number.
Absolutely. It shows unemployment isn't monolithic.
Okay, this focus on production and economic health brings us to GDP, gross domestic product. Henry Hazlitt's Economics in One Lesson offers a powerful perspective here.
A class.
He wrote, "Our real objective is to maximize production. In doing this, full employment becomes a necessary byproduct. But production is the end, employment merely the means."
Shifting the focus from counting jobs to understanding the activity creating those jobs.
Exactly. And the latest GDP data showed a significant rebound. The second estimate for Q2 2025 showed real GDP increased at an annual rate of 3.3%.
A strong turnaround from the 0.5% decrease in Q1 shows renewed economic vigor.
What drove that 3.3% increase?
2 main things. First, a decrease in imports, which are subtracted from GDP, so fewer imports boost the number, suggesting stronger domestic activity. Second, a noticeable increase in consumer spending, the biggest part of GDP.
So consumers open their wallets again.
It appears so. Now, this growth was partly offset by decreases in investment and export, so not every component fired on all cylinders.
And this 3.3% was revised from an earlier estimate, wasn't it?
Yes, it was revised up by 0.3% from the advance estimate.
Why the upward revision?
Mainly due to upward revisions in investment, particularly intellectual property, equipment, structures, suggests businesses are investing for the future. Also, upward revisions to consumer spending in areas like pharma, healthcare, and food services.
So even stronger business investment in consumer spending than first thought.
Correct. Though there were also downward revisions to government spending and upward revisions to imports, which moderated the overall increase slightly, but the net result was still very positive.
Were there other positive economic signs alongside GDP?
Yes, real gross domestic income. Or GDI, the total income earned from production, that increased a strong 4.8% in Q2.
Much better than Q1.
Much better. GDI only rose 0.2% in Q1, so a big acceleration in income generation. And corporate profits rebounded significantly, too, up $65.5 billion in Q2 after falling $90.6 billion in Q1.
So profits are back up, giving businesses capacity to invest and hire.
Exactly, the overall implication. Rising GDP, rising GDI, rising profits, despite the complex labor market numbers, all point to solid underlying economic activity. This fundamental growth, as Hazlitt implied, creates the foundation for jobs.
Even if employment figures are nuanced, the economic engine is running strong.
And that strength often creates those specific, targeted opportunities that skilled recruiters are perfectly placed to fill.
Which brings us full circle, doesn't it? Back to the core mission and Bob Marshall's unchanging truth for recruiters.
The fundamental reality of our work.
He constantly reminds us about the specific market we serve. He says, we, on the other hand, are engaged by our client companies to find those candidates who are happy, well appreciated, making good money, and currently working.
The passive candidates.
And we entice them to move for even better opportunities, especially where new technologies are expanding. This doesn't change, does it? Regardless of the headline unemployment rate.
It's the constant in our profession. Our focus is on the employed, the proficient, the sought after, and that segment is always in demand.
So when you connect all these data points we've discussed,
the business confidence nuances, the ADP job and pay figures, the JOLTS churn, the specific low unemployment for professionals.
It all reinforces Marshall's point.
It absolutely underscores his enduring truth. There's ongoing demand for specialized talent, especially in growth sectors, areas hit by new tech. These roles are less susceptible to broad economic swings.
Candidates in these roles aren't browsing job boards.
Generally not. They're open to genuinely superior opportunities presented proactively. That's our value. Bob Marshall states it firmly. This will never change.
And his conclusion.
And that is why, no matter the overall unemployment rate, we still need to market to find the best possible job orders to work, and we still need to recruit to find the best possible candidates for those job orders.
Market and recruit. The two core functions remain essential.
Always. His perspective encourages us to lean into that mission, use these insights, refine our strategies, and deliver value.
Okay, so let's summarize a key takeaway from Bob Marshall's August analysis. While the general economic numbers provide the wide view, his insights reveal that crucial, resilient, active market for skilled professionals.
That's the heart of recruitment.
It operates with different dynamics than the headlines suggest. So here's a final thought for you, our listener, to mull over. Given Bob Marshall's compelling analysis that there's effectively no unemployment among the management, professional, and college-degreed candidates you target, what new, perhaps innovative, strategies might you employ?
How can you consistently identify and crucially engage this hidden talent? The top performers who aren't actively looking but represent the best in their fields.
Something to think about. Thank you for joining us on the Deep Dive today.
We encourage you to continue your own examination of the labor market, always digging for those deeper, actionable truths within the data.